Today you are going to learn partnership fundamentals. In this chapter, we are going to discuss the concepts which are relevant for the subsequent chapters like admission, retirement, death of a partner. The concepts are partnership deed, profit and loss appropriation account, fixed and fluctuating capital method, interest on drawings, interest on capital. First, we will see the partnership deed. What is partnership deed? It is a document containing the agreement. Already you have learnt in 11th standard. If there is no partnership deed or the deed is silent, some conditions are given. Profit sharing ratio will be equal. So nothing is given in the sum means the ratio should be taken as 1:1. Interest on loan by partner is allowed at 6%. It is a charge. No salary commission is given. Interest on drawings is also not charged. So, if there is no partnership deed, you have to follow these conditions. Then, what is P&L account? You people are familiar with this. So, in P&L account, these are all charges. So manager commission is a charge, so it is written on the debit side. Rent to a partner is also a charge, it is written on the debit side. Interest on loan on the debit side. This is also interest on loan. This is firm is taking the loan, so they are paying the interest. Here the partner will take a loan from the firm, so he is paying the interest. So it is an income item for the firm, so it is credited here. So the difference will be profit, net profit, transfer to P&L appropriation account. What is P&L appropriation account? It is nothing but extension of P&L account. So this net profit will be transferred from profit loss account to profit loss appropriation account. So here it will be transferred here on the credit side. If it is loss means it will come here. P&L appropriation account, in this side is debit side, this side is credit side. Here all the expenses will be written from the firm's point of view, like interest on capital, partner's salary, partner's commission. If anything is transferred to general reserve, profit transfer to general reserve will come here. This side interest on drawings, because interest on drawings is an income for the firm. So the difference, if this side is more than this side, that is credit side is more than the debit side, it will be profit. If debit side is more than the credit side, it will be a loss. First we will see one sum based upon this concept. X and Y are partners sharing profits in the ratio 3:2. Capitals are given as 8 lakhs, 6 lakhs respectively. Interest on capital is agreed at 5% per annum. Y is to be allowed an annual salary of 60,000 which has not been withdrawn. Which has not been withdrawn means Y has not withdrawn this salary from the firm. Profit for the year ended is given before interest on capital. Before interest on capital means before charging interest on capital. But after charging Y salary. What is after charging means after debiting, after deducting the salary, the profit is 2,40,000. Then a provision of 5% of the profit is to be made in respect of commission to the manager. This commission is a charge. So you are asked to prepare an account only. Why they have not given whether it is P&L appropriation account or P&L account, we have to be very careful because manager's commission is a charge, so it should come only in P&L account and not in P&L appropriation account. So to manager's commission 15,000, this is nothing but profit is given as 2,40,000. This is after Y's salary. Now Y's salary is 60,000. So after deducting Y's salary only, it is 2,40,000. So before deducting it, it will be 3 lakhs. And it is given manager's commission 5% of the profit. So 5% of 3 lakhs is 15,000. So you get a difference of 2,85,000. This 2,85,000 will be transferred to credit side of P&L appropriation account. Now we are going to write the salary, interest on capital and all. So in P&L appropriation account, Y salary is written first. Then interest on capital for X and Y. This is nothing but 5% on 8 lakhs is 40,000. 5% on 6 lakhs Both are given here in the problem, capital. So 5% of 6 lakh is 30,000. You get the difference. So the difference is 1,55,000. That is divided in the ratio. It is given 3:2 is the ratio. So in that ratio it is distributed. So profit is distributed 93,000 and 62,000. So X get 93,000, Y is getting 62,000. Now one more sum is done of this type. Prem and Manoj are partners and they are sharing the profits and losses in the ratio 3:2. The deed provided that Prem is to be paid salary of 2,500 per month, it's given. So you have to be careful here. It is not for 1 year. So you have to multiply this by 12 so that you will get annual salary. Manoj was to get commission of 10,000 per year only. So no problem here. Interest on capital 5%, interest on drawing 6%. But even though percentage both for interest on capital, interest on drawings given, interest on Prem's drawing separately given. So if percentage and amount both are given, we have to take only the amount. So interest on Prem's drawings 1250 and Manoj drawings 425. Like that, interest on capital also given in the question, 10,000, 7,500. And net profit is given as 90,575. So in P&L appropriation account, by profit is 90,575. And all these are expense item from firm's point of view. So salary 2,500 into 12 for 1 year it is 30,000. Commission Manoj capital commission is 10,000. Then interest on capital for Prem and Manoj 10,000, 7,500 given in the question. This is interest on drawings for Prem and Manoj. Credit side it's an income item. So 1250,425. If you find the difference, you get divisible profit 34,750. Again this is distributed in the ratio 3:2. So you get 20,850, 13,900. Now preparation of capital account and current account. This is nothing but fixed capital method, and there are two methods actually, fixed capital method and fluctuating capital method. So in the question it will be given whether to follow fixed capital method or fluctuating capital method, or sometimes current account will be given. So if current account is given, that means they are following fixed capital method. So both the methods I will explain now. In fixed capital method, you will open capital account and current account. So in capital account, only capital amount will be written, opening balance, and then capital withdrawn and additional capital introduced. All the other adjustments like interest on drawings, interest on capital, drawings, then salary, commission, all these items will go to current account. But in fluctuating capital method, all the items, whether it is capital or additional capital or capital withdrawn, all adjustments like interest on drawings, interest on capital, salary, commission, everything will go to capital account itself. Based upon that, I have done one sum. A, B, C are partners. They are entitled to draw up to 7,000 per month. 7,000 each and every partner can withdraw per month. On first day of every month, A, B, C drew 7,000, 6,000, 5,000 respectively. Interest on capital and interest on drawings fixed at 8%, 10%. Here also I want to tell you one thing. It is not given per annum. 8% per annum, 10% per annum means we have to take the time into consideration, the date into consideration, from which date you have to calculate. But per annum is not given, so you can ignore time factor. So directly you can calculate 8% and 10%. Profit for the year ended is given in the question, out of which 2 lakhs is to be transferred to general reserve. Then B and C are to get salary of 30,000, 45,000 per annum respectively. And A is to receive commission of 10% on distributable profit after charging such commission. This I will explain again when I do the commission calculation. On 1st April, balance of their capital account is given as 5 lakhs, 4 lakhs and 3 lakh 50,000. You are asked to do P&L appropriation account. Already you people are familiar with that. And you are asked to do capital account also when capital accounts are fixed, when capital accounts are fluctuating. So first I have done the P&L appropriation account. By P&L account 7,55,000 given in the question. 2 lakhs is transferred to general reserve. It's given in the question. So I have written first general reserve. Then interest on capital for A, B, C. Capital amounts are given in the question. 8% is given. So I have calculated this. So 40,000, 32,000 and 28,000. So the total comes to 1 lakh. Partner salary only for B and C 30,000, 45,000. A's commission is calculated in the working notes. How it is done I will tell you. Before that, by interest on drawings 84,000, 10%. Here also time factor is ignored because per annum is not given. So what I did, add all this, that is 7,55,000 and 21,600 you have to add these three items, find the difference. So if you find the difference, you get here. Now 7,55,000 plus 21,600 minus 1 lakh minus 75 minus 2 lakhs. If you calculate this, you get 4,01,600. It is given in the question, commission is calculated at 10% on the profit after charging such commission. This concept already I taught you in 11th standard. If it is after charging, it should be 10 by 110. So 10 by 110 of this is 36,509. So this is written here as A's commission. Now if you calculate the difference, you get 3,65,091 and it is distributed equally for A and B. Why I have given bar current account means, if you follow fixed capital method, you have to write it as current account. If it is fluctuating capital method, you have to write capital account. For that only I have done like this. So if fixed capital method is followed, as I told you, we have to do the capital account and current account. So in capital account, only capital amount will come. Buy balance brought down, opening balance, no other adjustments. So to balance carry down and buy balance brought down. So adjustments are not written here. But in current account, see, all the adjustments will come. Here what happens, you will write all the income item for the partner on the credit side. By interest on capital, by partner salary, by A's commission, by profit. This side, two drawings, interest on drawings. Find out the balance. So you get a difference like this. This is a closing balance of current account. So in fixed capital method is followed, you do capital account and current account. Supposing you are going to follow only fluctuating capital method. Here what happens, we will write all the items in the capital account itself. Buy balance brought down, opening balance, and all these are again income item for the partner, interest on capital, partner salary, A's commission, profit. This side drawings, interest on drawings. So you get a difference of, this is the amount, this is the closing balance of capital account. So I think you are clear with now preparation of P&L account, P&L appropriation account and partners capital account and current account, and what are all the provisions if deed is silent, all that we have finished. So based upon that you can do the sums. Thank you.